Maneesh Dangi now joins us, and the reason why we invited him back on the show today is to remind our viewers that Maneesh was perhaps one lonely macro guy who called or who made a case to buy into equities purely based on the macro trends. The macro trends which Maneesh shared with our viewers were that globally liquidity is abundant, valuations were reasonable, and if you make time as your friend, then if you bought stocks in April and perhaps early May, you could have been rewarded. And guess what? The rewards have come instantly. So Maneesh, fantastic. Very rare macro guys, they come on our show and talk about equity valuations and talk about asset allocation. But it's good to hear a debt fund manager who got his call on equity and asset allocation completely right.
Good morning, Nikunj, and thank you very much. Markets actually keep score, so there's absolutely no point celebrating them. But yeah, I mean, we're happy that we got the framework right.
Okay. Maneesh, your bullishness last time was centered around three factors: low liquidity, low cost of holding, and reasonable valuations. Now, two of your three important pillars or two of your three important pointers are still intact, which is liquidity is abundant and cost of holding any asset is going to be absolutely zero. But valuations are no longer so-called attractive, or valuations are no longer as depressed as what they were, let's say, in May. So for somebody who wants to say, look, I did not believe Maneesh Dangi when first time he came, but this time I want to believe his call on equities. Should one expect double-digit returns from equities from here also?
True, Nikunj. In the month of April, if you had heard us, perhaps, there was 22% of returns on table, annualized returns for 5 years. A very significant percentage of that has already come in, and therefore what remains on table now is only 10-12% return. So it is true that some of the valuations have up-corrected, but it's also true that now we have a promise from majority of central banks and most importantly Fed that interest rates would stay low for very, very long. And that essentially means that the financial repression would continue for very, very long. The typical fixed income instruments, if you are a US citizen, is unlikely to earn anything whatsoever for next 3, 4, 5 years. So therefore, you don't have much of a choice. I think you could argue ditto for an Indian investor also to a large extent. So I think there is still a case of 10-12% return in India equity over next 4-5 years. I'm talking of annualized returns here.
Maneesh, globally interest rates are low, but locally inflation is back and the bond yields are at 6%. Now, when you're making a view on India, you have to look at India's cost of capital and India's cost of borrowing, and that's where the uptick already has kicked in. So some would argue that globally low interest rates regime is here and it's here to stay. But if Reserve Bank of India did not cut rates in the last policy meeting, and if bond yields are north of 6%, so that uptick which we are anticipating is perhaps over.
Look, there are two parts to your questions. One, of course, is one has to understand that majority of risk in the world is launched from dollar markets. In a sense that sometimes one could argue that irrespective of where your interest rates are in India or Indonesia or Philippines, your equity markets are actually driven by what's available in terms of rent or yield in dollar markets. So to that extent, I think the bigger problem to solve for equity markets is always about where the dollar yield would be. That's one. Number two, I understand that Indian interest rates are unlikely to go down sharply from where they are right now. But the big theme of financial repression is playing out even at these yields. You ought to understand that even at the levels that we are today, you are actually, as a fixed income investor in a fixed deposit, you are earning negative returns. And it's very likely that this would continue. As a matter of fact, our reverse repo is just 335. Banks are deploying huge amount of money at 335 every day. The depositors are deploying their money for 1 year, 2 year at 5% or thereabouts. And it's very, very likely that the banks would actually bring down these 1 year, 2 year fixed deposit rates for next 1, 2, 3 years. So I think the broad theme that there is a financial repression, that there is very little that you earn in fixed income, real returns, I mean, which is why you must go to equities. Now, that number is not going to be nominally zero in India because India has some lower bound of inflation. We have seen in last 7 months, despite growth collapse, the inflation has been stubbornly 6% and above. Of course, some of it would unwind, and yet I am sort of fairly certain that India has a bit of a lower bound on inflation at 4% or thereabouts. So India's real returns in fixed income, even at 5% of fixed deposit or 4.5% of 2-year AAA rate, would stay low and very low. And which is why the lure for equity should be intact, even for an Indian investor.
Manish, there are two ways to look at this scenario. One, you tilt towards small and mid-cap stocks because that's where valuations are attractive, that's where bombed out pockets are there. Second is that you go for macro trade, which is, like you've been mentioning in your newsletters, dollar weakness is real, dollar weakness is here to stay, and if dollar is weak, you'll have to go for assets which will create inflation. What should one do?
See, in March and early April, we did put out these memos that, the dollar would weaken almost secularly for next many years, because at least we saw this as a part of a policy design from policymakers, both Fed as well as, I think, Treasury in US. So the dollar debasement is here to stay, and that's also explains why gold is sort of doing so well. So in a sense, whenever dollar does well, while it is a part of a sort of a very, very well thought out policy of Fed, I guess it is, no one is complaining in the world. It is actually a good news for the rest of the world, because dollar debasement or dollar depreciation leads to reflation pretty much across the world. So in a sense, when dollar weakens, other currencies sort of strengthen, and that brings the risk appetite back. A lot of our corporates and corporate in emerging markets have borrowed in dollar, and when there is a deluge of dollar, when there is oversupply of dollar, the concerns of refinancing them actually fade. So to that extent, dollar debasement and depreciation is actually very good news for emerging markets. And therefore, we continue to think that over next many years, given that it's this hyperactive, hyper-stimulating policy of Fed is likely to stay, we would continue to see dollar deluge. We will continue to see large amount of flows coming in India as well. I think we've discussed about this, Nikunj, many times, that I'm actually very, very constructive on India FDI for next couple of years. It's very likely that over next 1 to 3 years, annualized balance of payment surpluses in India would be close to $75 to $100 billion. Now that's a hell lot of money. $100 billion essentially means if RBI were to sort of suck that money, it essentially means almost about 6-7 lakh crores of excess liquidity in the system every year, annually. What is that money going to do? It's going to leak into a variety of assets. To start with, we are starting to see, even in India, a lot of money is starting to move out of banking system. Perhaps it will go to real estate. And I am actually quite constructive on small city real estate as well. And I'm very certain that a lot of this money would go to equity mutual funds, and would essentially means valuations would still be driven higher and higher because of flows of local money as well.
What do you make of this entire idea where today some of the big companies which are there in the world, they manage to grow without raising a single rupee or single dollar of capital, or have zero debt, whether it is Microsoft, Amazon, Apple, Netflix? What happens to that end of the market where private funding, PE funding, startup capital, everything has changed now?
See, look, the world that we live in actually has arguably a saving surplus. What Bernanke argued early 2000, that there is a saving glut in the world. And I think, the case for the saving glut has actually risen. See, all of us have to sort of fundamentally understand a point that there are far too many rich people in the world today who actually earn far, far more than what they spend. Now that excess money is ready to dial some sort of risk. Okay. Initially, I would say in a developing country, intermediation of capital is done by instruments like banking deposits. The banks actually collect money from depositors and give credit to a corporate who are levering up and perhaps putting up big plants and taking risk. This is what is happening in India for the last many years. But then, in I would say postmodern world, in countries like Japan, US, and even to a certain extent Europe, people themselves are ready to sort of invest directly in the risk, and which is what has happened. That this big boom in private equity, big boom in venture capital. A lot of this money actually is the same people who until about a few decades ago were actually depositing money in the city banks and JP Morgans, and earning 0.5%, 1%, 2% real returns. But they are now confident enough to sort of dial directly. So in a sense, you are experiencing a disintermediation in the world of capital. And the second part, of course, that you talked about is, firms like Microsoft, Google, these are money machines. They don't require, what do you call it, a debt. At least all of these fangoms, or fangs, have one big cash engine, which is actually throwing up so much cash that, they themselves have a struggle of deploying it. And the good news is that these are all frontier companies. Unlike oil companies, they are ready to sort of invest in new tech, and which is why this is breeding a new culture, a cult of frontier investing. One of the reasons why India's, so many, new firms have come up, and, a lot of them have been funded by these venture funds, is because, some of these firms are ready to sort of dial incremental risk. So the old paradigm, Nikunj, that, whatever money that you have, you must save or return to the investor. That's not working out. It's actually that a lot of these firms are venturing out and actually investing in moonshot technologies. And that's actually very good news for the productivity growth of the world.
Maneesh, an investor will have 3 or 4 choices. One, go towards equity, which comes with its own attachment of volatility. Go towards fixed deposits, where returns are only going to be diminishing and diminishing and diminishing, and if I could say diminishing once more again, diminishing. Go for real estate and go for fixed income. We've discussed equities and we've discussed fixed deposits. Let's understand debt market now. Debt investors make money when interest rates go down or interest rates remain soft. The government yield currently is at around 6%. What should debt investors expect now?
So we've discussed about debt to the extent that there is a financial repression. And now for the debt investors, you of course in India have 2 choices. One is this traditional instrument called fixed deposits. And we've discussed about this, that, banks are not going to be offering good fixed deposit returns. Because, as we discussed, I think a couple of days back also, Nikunj, that, banks have this huge money. Every day they're depositing almost 7-8 lakh crores of money with RBI at 335. So there's absolutely no incentive for a bank to raise more deposits. So why should they even offer 5%? So my bet is that, fixed deposit rates would actually continue to go down. Now, let's talk of fixed income. You see, fixed income has 2 components. One is, of course, capital gains when interest rates go down. Whatever that you've invested in, those investments get repriced higher because interest rates have gone down. And that forms part of the capital gain that you have. The other part, of course, is the accrual. So when you buy a 10-year government bond, you're very likely to earn 6% for next 10 years. When you buy a 0.5% or 75 basis point US Treasury for 10 years, you're very likely to earn 75 basis point US Treasury returns. So in a sense, it's not that bad in India. It's very likely that India's inflation would be there 4% or thereabouts. So if you're a long-term investor, there is a reasonable risk premium available to you for 10 years, almost 2% excess that you would earn over, inflation, which is not a bad thing. It's just that if you're a short-term investor, what a typical investor that you and I are talking to today, they're all 1 to 2 year investors or 1 to 3 year investors in fixed income. There, the risk premium is not available. There is no opportunity for the capital gain now because 2-year, 3-year PSUs have actually trended towards 4.5% to 5% now. So the space for them to rally significantly is not there. So yet, what is available is the 4.5% to 5% of carry. Okay, you could invest in AA plus corporate and perhaps earn near 7%, but that's about it. In a sense, the habit of an Indian investor, a typical fixed income investor, is that he tends to invest only for 1 to 2 years or 1 to 3 years. In that space, there is not much return that you can extract because capital gains are unlikely to play out and the carry is actually plunged quite dramatically. So therefore, if you could change your habits, if some of your money is actually for very long term and you still want to deploy yourself in fixed income and don't bother too much about the mark to market losses, as you sometimes don't do as far as equity is concerned, you could invest in a 5-year, 10-year instruments and still hope to earn, somewhere between 6-7%. Okay, so concluding that the trade-off has to be made. You can't stay in a fixed income fund for 1 year and hope to earn 7% return. But if you have a plan to stay and stick around for longer term, that kind of return is still possible today.
Well, Maneesh, fantastic to have you back. Thank you for joining us and thank you for walking us through the importance of asset allocation. Seldom people come and say and insist on the importance of asset allocation, but I'll say it again, 80% of the money is made by the asset allocation. It's important to have a combination of debt, equity, fixed income, and sometimes real estate, right? Stay safe, my friend. Good to have you back, and thank you for joining us.
Thank you. Thank you very much.